Cathie Wood warns about deflation versus inflation in 2021. Hello lovely YouTube family, welcome back to The Wealthy Brains. Before we start, I want you to hit that red subscribe button so that you never miss out on any of our videos. Many investors are concerned about the incoming inflation in the market. For years, economists worried that broad macroeconomic changes such as an aging population, fewer babies, the advent of automation would keep prices anchored for decades. But the U.S. Labor Department's most recent inflation print has shocked the stock markets, and investors are worried about a return of inflation. Hello and welcome to Wealthy Brains, where we bring you topics related to your money. Do subscribe to our channel so that you never miss an update. In today's video, we're going to analyze the claims of an impending deflation, a prediction which is in stark contrast to several experts who believe that there is an incoming inflation on the way. However, if Cathie Wood, founder and CEO of ARK Invest, is to be believed, the big risk ahead over the next 5 years is deflation, not inflation. And it will benefit only those investments which are involved in innovation strategies. Innovator companies whose share prices have tumbled 30% to 35% from their heights earlier this year are likely to return 25% to 30% in each of the next 5 years from their current levels, Wood has predicted. While the current situation is similar to the run-up in prices from 2006 to 2008, the bond market is signaling that may not be the case, Wood said. Instead of a 10-year Treasury yield rising significantly as they did during the 2008 financial crisis, the bond market has settled down following a sharply higher move in yields earlier in the year on inflation fears and the potential impact of higher taxes on capital gains, she said. Wood offered her views on potential market winners and losers in a period of deflation in her monthly webcast for May. In the webcast, she listed out the types of deflation that we might be seeing in the near future. Treasury yields are not moving higher because the bond market is now seeing 3 sources of deflation according to Wood. Number 1. Good deflation. First, bond market investors see what Wood called good deflation coming from investment in innovation by product-making pharma that will spur an economic boom. Wood cited several examples of good deflation she expects from innovation strategies. Like the advance in DNA sequencing can lead to lower healthcare costs, impacting prices in 20% of the economy, potentially bringing deflation to the healthcare sector, where costs have risen steadily over time. There is room for continuous improvements and cost savings ahead. Also, advances in battery pack capabilities are another example of good deflation, Wood said. For every cumulative doubling of capacity in battery packs for electric vehicles, costs drop 28%. Wood also foresees potential deflation from a decline in artificial intelligence training costs, which, she said, are expected to drop between 37% and 50% a year. Artificial intelligence is anyway going to enter every sector, every industry, every company eventually. Number 2. Bad deflation. The good deflation from innovator strategies will spur the bad deflation from the creative destruction of companies that fail to innovate, Wood said. That means the companies which do not focus much on the innovation part will lose out heavily in terms of consumer satisfaction of their products, which will in turn give rise to bad deflation. Roughly 50% of the S&P 500 is at risk by this creative destruction, Wood said. Those companies spent the last 20 years catering to short-term investors who wanted their profits, and they wanted them now. Companies that were leveraging up to buy back shares and not investing enough in innovation, these companies did not take seriously the threat innovation posed to their businesses and might have to pay for the black of it now. The potential commercialization of electric vehicles was seen as being a decade away in 2014 when ARK Investment was launched, Woods recalled. At the time, however, she viewed it as already underway. Now we see auto manufacturers are scrambling, and we can even say scrambling for their dear life, Woods had to say. As demand for autonomous electric vehicles takes up, it will put a big dent in oil demand. The 2 sectors, energy stocks and financials, have done best this year, but will see big impacts from creative destruction, according to Woods. In the financial services sector, growth in assets held in digital wallets is moving at a pace that is faster than anyone could have believed. China has already showed the way with the WeChat app and now Alipay. In the past 5 years, Venmo and Square's Cash App have been moving so quickly that their user bases have rapidly scaled up to a level higher than JP Morgan's customer base. Wood asked the financial service buyer to be aware of the digital wallet evolution, which has kind of gone viral. However, there might be yet another source of deflation on the way, according to Woods. Number 3. Commodity prices. The third source of deflation will come from falling commodity prices that might take place as early as the end of this year, maybe next year, owing to the ongoing pandemic. Consumer have shown a hell lot of interest in buying commodities online from the safety of their homes, and hence there is a huge pressure on the e-commerce companies to deliver. As a result, there is a lot of double and triple ordering taking place right now, she said. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. Wood expects inventories to build to a level well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices and hence the resultant deflation. She cited the soaring breakout all-time high in the price of copper from its 15-year trading range as an example that commodity prices that are vulnerable to a correction. Wood acknowledged her investing strategy based on future deflation comes with risks. If we are wrong, then we will be perhaps uniquely wrong, Wood said. Even so, the reward can be greater. She thinks that in these times, if we do take a stand differentiated from the crowd for a good reason and not just to be on the contrary side, the payoffs can be enormous. According to her, the bull market has broadened out and everyone is looking forward to innovation rejoining the party. In April, ARK Innovation Fund invested $246 million in Coinbase shares when the company went public on the Nasdaq. At the same time, ARK sold some of its Tesla stock even after Wood said in March that she thought Tesla shares could hit $3,000 by 2025. Well, Wood definitely has an entirely different perspective of the coming time, but one thing is certain, that innovation will be leading the way going forward, and for investors like us, that should be the key factor in deciding the stock to invest in. That was all for today's video, folks. We will come back with yet another video next time. Till then, don't forget to press the bell button and subscribe.